Here is a question that, once truly grasped, can shatter the foundations of your understanding of modern finance. A deep, unsettling paradox at the very heart of the global economy. We are taught that money must be earned, mined, or borrowed. But what if the ultimate source of money simply creates it? The Federal Reserve, a quasi-governmental entity that conjures trillions of dollars into existence, with nothing more than a few keystrokes on a computer screen. No vault of gold backs it. No hard assets secure it. No one deposited anything beforehand. They simply will it into being. Look back at the seismic financial upheaval of 2020 and 2021. In response to a global crisis, the Federal Reserve generated an astonishing, almost incomprehensible figure, $6 trillion. $6 trillion materialized, effectively, out of thin air. It was not mined from the earth. It was not earned through trade or services. It was not borrowed from any existing source. It was an immaculate conception of currency, a digital entry that became real spending power. But this act of financial creation carries a profound, hidden contradiction. Every single dollar bill you hold, every piece of paper currency in your wallet bears the same cryptic inscription at the top, Federal Reserve Note. The word note is not merely a label. In the world of finance, a note is a formal debt instrument. It is a promise to pay. When you sign a promissory note for a mortgage or a car loan, you are acknowledging a debt and promising a future repayment to a creditor. That note is debt. This semantic reality forces a stunning conclusion. Every dollar in existence is technically debt. Someone, somewhere, owes that dollar to someone else. Now, we return to the chilling core of our question. If the Federal Reserve creates these dollars ex nihilo out of nothing, and those dollars are inherently debt instruments, a note, a promise to pay, who then does the Federal Reserve owe the money to? Pause and truly consider the implications. There was no lender. No pre-existing capital was used. They created the principal from the void. In this transaction, who is the creditor? If dollars are debt, and the Fed is the one creating the debt, to whom is the obligation owed? The logical, simple answer is that the Fed owes no one. But the actual answer, the mechanism by which this entire system functions, is the realization that the entire modern monetary architecture is a complex, century-old device designed to facilitate a continuous, silent transfer of wealth from the public to a select, private financial elite. The Federal Reserve, in a shocking twist of power, owes the money to no one. Yet, it creates the debt that the United States government must service. And who is the primary creditor of the United States government in this manufactured debt cycle? The very institution that created the money from thin air, the Federal Reserve. An institution that, as we shall soon see, is owned by private banks. Your government borrows money that was conjured from a digital ether, and then it is obligated to pay interest on that ghost money, forever, to a private cartel. And who ultimately pays that perpetual interest? You do, with your taxes. This is not a fringe theory. This is the documented, legal reality of the financial system. It is arguably the greatest scam in financial history, operating in plain sight for over a century, yet remaining invisible to the vast majority of citizens. This is the untold story of how money is truly created, who really holds the levers of the Federal Reserve, and why the national debt is not merely a political problem, but a mathematical necessity that can, by design, never be repaid. The system, by its very function, demands permanent debt and permanent interest payments flowing from the public purse to private banking entities. Before we fully expose who profits from this system, we must first confront the common delusion about the structure of the Federal Reserve itself. Context: the illusion of government control asks everything you believe about the Federal Reserve is likely tinged with a fundamental misunderstanding. Most Americans operate under the assumption that the Fed is an integral part of the government, a venerable, transparent federal agency, much like the Treasury Department or the Internal Revenue Service. It is not. The Federal Reserve is, in essence, a private banking cartel with a veneer of public oversight. Its creation in 1913 through the Federal Reserve Act was not a victory for democratic control of the currency, but a masterstroke engineered by bankers for bankers, explicitly designed to consolidate control over the nation's money supply and lending power. To understand the deception, look at its actual structure. The system is split into two parts: Board of Governors in Washington, D.C., 7 governors appointed by the President and confirmed by the Senate. This is the public face, creating the illusion of government control. They set policy. The 12 regional Federal Reserve banks, institutions like the Federal Reserve Bank of New York, Chicago, and San Francisco. These 12 banks are the engine room of the system. Critically, each of these 12 regional banks is a private corporation, not a government entity. And who owns these private corporations? They have shareholders, and those shareholders are the private commercial banks. that operate within their respective districts. JPMorgan Chase, Citibank, Bank of America, Goldman Sachs, Morgan Stanley, the titans of American finance, are literally shareholders in the Federal Reserve Banks. They own the mechanism that governs their industry. While the Board of Governors in D.C. makes the policy decisions, the private regional Federal Reserve Banks execute the actual work. They create the money, interact directly with member banks, and hold the crucial assets like government bonds. The structure is a brilliant institutional cloaking device. Every commercial bank that is a member of the Federal Reserve System, which includes all the major players, is legally required to purchase shares in their regional Fed bank. A bank like JPMorgan Chase, headquartered in New York, is therefore a shareholder in the Federal Reserve Bank of New York. And here is the immediate and permanent reward for this private ownership. These shares are not speculative stock. They pay a guaranteed, risk-free dividend, often set by law at 6% per year, no matter if the economy booms or collapses, no matter if the Fed makes a profit or a loss. Member banks are legally guaranteed a 6% return on their Federal Reserve shares before any profits are ever remitted to the U.S. Treasury. This is a crucial, non-negotiable legal commitment, an internal subsidy written into the foundation of the system. So, let the gravity of this reality settle in. The Federal Reserve is a profit-making entity owned by private banks, paying guaranteed dividends to those banks, and yet simultaneously holding the ultimate, unchecked power to create unlimited currency. Why would the government, an entity established to serve the public good, ever cede such monumental, sovereign power to a private consortium? The answer lies in the dramatic and deliberate deception of 1913. The largest, most powerful banks of the era, led by figures like J.P. Morgan and the Rockefellers, skillfully lobbied Congress. They argued, convincingly, that a central bank was necessary to stabilize the economy and prevent catastrophic bank runs, citing the financial chaos of the Panic of 1907. While the premise of stability had some merit, the true, overriding motive was the seizure of control over the money supply. For, as the saying goes, whoever controls the money supply controls the nation's economy, and ultimately controls the government itself. Before 1913, the United States government possessed the constitutional authority to create its own money, free of debt. After the Federal Reserve Act, that power was effectively transferred. The government was no longer the creator. It became the borrower, required to go hand in hand to a private banking cartel, the Federal Reserve, to fund its operations. The Act of 1913 was arguably the single largest, most significant transfer of sovereign power in American history, executed not on a battlefield, but in the hushed, gilded corridors of finance. Pattern reveal: the magic trick of open market operations though truly grasp the scam. We must look beyond the ownership structure and into the technical mechanism of money creation. This is where the sleight of hand occurs, transforming nothing into debt and profit. The process begins with the government's need for money. Step 1. The deficit. The U.S. Congress passes a budget. Let's imagine a scenario. They need to spend $5 trillion this year, but tax revenue projections only bring in $3 trillion. This leaves a $2 trillion deficit. They must borrow the difference. Step 2. The Treasury issues debt. The Treasury Department, acting on behalf of the government, issues Treasury bonds. These bonds are IOUs, a solemn promise by the U.S. government to pay back the principal amount, plus interest, over a set period. The Treasury then holds an auction to sell these $2 trillion in bonds to raise the necessary cash. Buyers include foreign nations, pension funds, mutual funds, and commercial banks. And, of course, the Federal Reserve. Step 3. The Federal Reserve intervenes. This is the critical juncture. The Fed decides, for example, to purchase $500 billion of those newly issued bonds. This act asks now, for the magic trick, where does the Federal Reserve get the $500 billion to buy these bonds? You would logically assume they must have that money already, perhaps collected from member bank deposits, profits, or assets. They do not. They do not need to. They are the monopoly creator. The process is almost absurdly simple, yet fundamentally revolutionary. The Federal Reserve's trading desk executes the purchase. The Fed asterisk